But June 28th was not like you were going to wake up that morning and the world was going to change. And so if that's what you thought was going to happen, frankly, shame on you. You didn't do the homework, okay? There's two important things here. One, how it's happening in stages, and two, why? You got to ask yourself, why is this happening? What June 28th was a deadline for the EU-based banks to be in compliance with this net stable funding ratio or net stable funding requirement, however you want to say it. Having your unallocated gold, you couldn't have it just on the books anymore. You had to have actually allocated gold. And there was a ratio cap. I don't even know if I can explain it, obviously. But what it did is it made holding just simply unallocated gold impossible in terms of, had to have allocated gold, actual physical gold, rather than all this phony baloney, trading unallocated accounts in London and everywhere else, and all the supported alleged hedging that these banks have been doing for years. So to bring yourself in compliance with that, you had to bring a capital ratio up to a certain level if you're going to keep doing that. Otherwise, you just get out of it. Now, this impacted the EU-based banks first. Okay? This wasn't like a system-wide world-changing event on June 28th. This was just the EU. So who are EU-based banks? Credit Suisse, okay? Deutsche Bank, UBS, all right? So these are bullion bank players, but this is not everybody. Now, then I went and I found somebody, actually I didn't find it, somebody emailed it to me. A notice from the US Comptroller of the Currency, which is the office that tabulates all the derivative trading and, and everything else. You get those reports once a quarter. They put out a thing in February that said, it sure read to me, and I sent it off to Alistair and asked him, I said, is this basically the same directive going out for US-based banks to get in compliance with all this stuff from Basel III? And we looked at it, yeah, sure looks like it. That's tomorrow, okay? Well, the world's not gonna end tomorrow either. Now, I definitely think what you've seen the last 2 weeks has a lot to do with these requirements being put in place. I mean, why was gold run down $100 on a short squeeze in the dollar? Interest rates have moved. Real interest rates still sharply negative, but gold runs down $100. Why? Because the futures tail wags the spot dog. If you can collapse the futures price, then the spot price goes down $100. And if you are underwater and you need immediate allocation to cover your unallocated stuff, or you need to get out of it completely, you'd sure rather do it $100 lower, here at the end of the month than it was at the beginning of the month. But anyway, it's a process. It's not just June 28th. And frankly, nothing can even hold a candle to the, fingers crossed, implementation of all this in London, the UK banks, and the LBMA on the first of the year, January of 22, 6 months from now. And what's going to continue to drive me crazy is we're very likely to continue to see these raids and this price pressure, because if LBMA is not let off the hook by January 1st, well, then all of those banks and all the obligations of the LBMA, that's going to become not necessarily a wasteland, but that's a lot of unallocated paper that's got to get covered and moved around, all that stuff between now and the first of the year. You think June was ugly? God knows what they'll try to do. And it was never going to be it's a big deal, okay, that these EU banks were called to the carpet finally. But it was never going to be. Again, check my Twitter feed. I've been telling people this most recently on Friday. It's like, before you head out for the weekend, understand that nothing is changing on Monday. The biggest disappointment, I even just wrote yesterday, I thought maybe we had a chance to have a really hefty, not like the COMEX is going to fail in July. You always get that crap too, and it's a lot of times it's the same people that come out, by this date certain, the COMEX is going to collapse. And I'm like, I've heard that before, and that doesn't do anybody any good. That's why this whole Basel III thing was just driving. But anyway, what we do want though is this continued demand, this robust demand, where there's really only so much silver flowing every year out of the mines and out of recycling that either gets chewed up by industrial demand or by investment demand. And when you get investment demand to eat up all the rest, I mean, the industrial demand is pretty steady at 550 or 600 million ounces a year, which leaves 250, 300 million ounces for everything else. And when you all of a sudden spike to 400 million ounces of investment demand, well, you're short, and then you got everybody's favorite Hell's Angel tries to tell you that there's, 5 billion ounces laying around if you count grandmother's candlesticks and silverware and tea setting. But, at $26, grandmother's tea setting's not for sale. Okay. So it's not like, it's just this big pile over here. Anytime London needs it, they can get it. So anyway, we got to keep the demand going. I thought maybe July'd be, because we still had 19, almost 20,000 contracts still open with 1 day to go. That's 100 million ounces. And usually it's a rather linear progression. Every day you get closer to that contract going off the board and into its delivery phase. You get people leaving that contract where all the action was, all the open interest, all the trading is usually what's in that called that front month. Right. So you get people rolling out of the front month of July into then the next one, which is September, or even farther out, December. There was 19, almost 20,000 left. They rolled that about 12,000 of those just sold. I mean, it's not like, there's anything, funky going on. They just sold, and about 5,000 rolled into September. The other 7 just gave up and said, I'm just out. I'm not gonna stand for delivery. I'm just selling my contract, which is what you do. I thought more like maybe 8,000 would do that, and we'd still have 12,000 hanging around, but instead, we have 8,000. So it'll still be a hefty month, still a lot of pressure, still more than, we ever used to see back in the day. But it's just another step on the road. We just got to keep the pressure up. So we just got to keep the pressure on. And that, again, I think we're doing okay. I mean, it's nice in terms of price. We came down, we've been hugging the 200-day moving average now for 8 or 9 trading days. Got below again yesterday, but then bounced right back today. We're now putting the end of the quarter behind us. That's always a good thing. I bought more silver yesterday. You probably bought some recently as well. So we're hanging in there. What's so important is that people understand that if you start, placing all your hopes on any one certain day, you're just going to be disappointed. And then you're going to walk away and you're going to give up your financial insurance that is, physical gold and silver. You're going to walk away from a repricing back to some, basis in the physical world that is going to be a financial windfall for you as well. So I try to keep everybody, kind of more focused on this bigger picture. I mean, the rubber band keeps getting pulled tighter and tighter, eventually you just don't know when it's going to finally snap. You look at it, begins to fray, and you think, oh boy, I certainly can't do this. And then you can do that. Well, okay. And that's kind of what's going on there.